Okay, welcome back to the Crypto Minute. This is another answer to a question. One of my friends, Mr. Logan, said he'd like to hear about the inverted yield curve on the US bond, how it relates to current hyperinflation slash wealth transfer, and volatility in the crypto market. So we're going to go over some of the things that he asked. All right, number one, we're looking at the 10-2 Treasury yield spread. Okay, now this is the 10 and 2-year Treasury bonds. So we're talking about bonds, all right? And they're highly purchased. And anytime you have the lower time frame high that's actually selling for higher than the higher time frame, then we've got problems, and the market usually has to correct. And it's a big sign usually that there's going to be a huge drop in the market, which is why, as I showed you at the very beginning screen, about all my put options that I've been buying. So we can see that this is below the 50% line or the 0% line, which obviously means at this point that the 10-year 2 is at negative, which means it's below. Okay, and I'm going to show you that with trading analysis as well. So again, the 10-year Treasury yield spread is the difference between the 10-year Treasury rate and the 2-year Treasury rate. A 10-2 Treasury spread approaches zero, signifying a flattening yield curve. A negative 10-2 spread has historically been viewed as a precursor to a recessionary period. And the further it goes negative, the further that happens. Okay, so number one, what happens when this happens is we have recession, and sometimes following by depression. So what do I expect? I expect the market, as I've said in some of my other videos, that is going to fall quite a bit, probably another 30 or 40%. Okay, we're taking a look at TradingView right now, and we're looking at the US 2-year, and what's it currently at? 4.297. And you can see I have my Fibonacci retracements on there. And now we're going to go look at, and remember that number 4.3 basically. And so I'm going to, and I'm using TradingView as always. So I want the US 10-year this time, and that's right here. And that's at 3.84. So that's a pretty big gap. Now, do you understand that if you buy a 10-year bond, you can get it for 3.8474%. Now, that's pretty damn good. But you can buy a 2-year bond for 4.3, as we just showed. So what is the response of the Fed to this? Oh, boy. All right. As we've seen, Jerome Powell will raise rates until he sees the economy break, until this starts to come back to that zero pattern, which we had right here, okay? Until it comes back to there and starts heading upwards before he even thinks about taking his hands off the brakes or breaking everything. So he's going to got to do that first. Number one, we have to have employment come down, and the market's going to have to see a huge drop. And remember, October and September are notoriously bad months for the stock market. Now, he did talk about hyperinflation. If the Fed is too slow to act, and there's some that say that, Powell has, that's why we got to 9.1%. And he eases too quickly. That always runs the risk of going back up like the 70s to plus 12% interest. So he can't take his hand off the, off the pedal at this point. So that's number one, two. He also mentions something about the wealth transfer and volatility in cryptocurrencies. Well, cryptocurrencies trade very, very similarly to the tech sector. And when we see, and check out some of my earlier videos about the market cycle and what happens during that, is tech usually gets hit the hardest. It's also one of the ones that comes back the strongest. But think about it. Look at the profits that you've been receiving over the last 2 to 3 years with us, and Tesla and Microsoft and Google and Apple. And most of these companies are badly, badly overinflated. Now, I want you to think, common sense always is your best friend when investing. So what is it that people are going to do without during a recession? Well, they're going to do without travel, and they're going to do without expensive things and probably cars. And so what we're going to see is in some of these other sectors, we're going to see huge drops. Now, please look at my video on calls and puts, because I was buying calls a couple of years ago. Now I'm buying puts, and it seems to be paying off. The rest of it, what do I have it in? Oh yeah, these bonds. I have it in the 6-month treasury yield, which is actually earning quite a bit. It's earning over 3%. All right, I hope you found this useful, and as always, God bless.